Lately, it feels like everywhere you look, the mood around silver has turned sour. You see it in video titles screaming that silver is about to get crushed. You see it in comment sections that sound like a funeral. You see it on forums where people are either angry, sarcastic, or completely done with the idea of owning metals. And here's the part that might surprise you. I don't automatically think those people are wrong. I'm not saying that to scare you. If you want something truly scary, just look at what's happening with US debt. That number keeps climbing like it has a mind of its own, and it recently crossed into territory that should make anybody at least a little uncomfortable. But when it comes to silver, I think the most dangerous thing you can do, especially in a market as emotional and as volatile as this one, is convince yourself that a certain outcome can't happen.
Because silver has already proven, more than once in modern history, that it can do things that feel impossible while they're happening. And I heard a phrase recently that I honestly think is one of the most accurate descriptions of silver I've ever come across. Someone described the idea of a price floor like this: the floor isn't really a floor, it's more like an elevator going down. Think about how perfect that is. Because if silver is an elevator moving downward, then eventually it doesn't matter how long it pauses on a certain level. Eventually, it doesn't matter how many people stand around saying, "This is the floor." Eventually, that elevator goes below that level. And when it does, nobody gets to vote on where it stops. Nobody gets to negotiate with the market. Nobody gets to say, "Yeah, but it shouldn't go there." Silver doesn't care what you think it should do. It doesn't care what I think it should do. It doesn't care how logical your argument is, or how many bullish charts you can post, or how many bearish headlines you can point to. It is going to do whatever it's going to do. And the people who get hurt the most are usually the ones who build a strategy around the belief that they've removed the possibility of being wrong. If you think that sounds dramatic, you don't even have to go back that far to see the proof. You can go back to 2011. If you pull up a chart of silver in 2011, what you'll notice immediately is how familiar the pattern looks. Silver started that year under $30 an ounce. Then it went on an absolute tear, one of those moves that pulls everyone in, makes every headline sound bullish, makes everyone feel like they're early to something huge. It ran all the way up to about $48 and change, and then it crashed hard. After that crash, something interesting happened, and this is where the psychology piece really matters. Silver started to stabilize. It traded around a level that people began to treat like a new base. And back then, if you were around, you remember the chatter. People started saying $30 was the new floor. Why did they believe that? For the exact same reason people say similar things today about whatever level they're focused on. Because after the crash, silver wasn't breaking below that level right away. It bounced, it held up, it spent time there, it even climbed again. It pushed back over $40 later that year, and that reinforced the belief. People looked at the chart and thought, "See, it's confirmed. It can't go below $30. That's the new normal." And then the elevator kept going. If you zoom that chart out a little further, silver eventually dipped below $30. And not only did it dip below, it stayed below for a long time. It wasn't a quick touch and then back up. It was a long, grinding reality check. You can look at the stretch that follows. From the period where silver fell under $20 around 2013, all the way through years of trading where it just couldn't regain what people had convinced themselves was the floor. That grind lasted so long that it broke people psychologically. And that's what prolonged downtrends do. They don't just take money, they take belief. Now look at the last 6 months of silver and ask yourself honestly, does this shape look familiar? You get the massive run-up, you get the peak, you get the sharp dip. Then you get this period where it seems like it's holding above a certain number. And now you're hearing the same thing again. This level is the new floor. But if silver is an elevator, it doesn't stop just because a lot of people feel comfortable on a particular floor. If that widely watched floor breaks, you might not like where it goes next. And if you build your entire plan around the idea that it can't break, You're setting yourself up for the kind of pain that causes people to panic sell at exactly the wrong moment. That's the real reason this matters. It's not because I want anyone to be bearish on silver. I'm actually extremely bullish long term. It matters because this is exactly where people get hurt, especially people who buy into hype, buy into FOMO, buy into the belief that the risk is gone. When you believe it can't go down from here, you buy differently. You stop thinking about risk and start thinking about profit. You stop thinking about time horizon and start thinking about flipping. You stop thinking about your budget and start thinking about how much can I buy before it goes higher. And then, when it drops, because silver is silver, reality hits. That's when the emotion shows up. That's when people feel betrayed by the market. That's when they say they should have never bought any silver. That's when they dump it, or swear it off forever. And here's a hard truth. If someone was buying silver at extreme highs with the primary expectation of getting rich quickly, and then price fell hard, it makes sense they feel burned. But in many cases, it's not that silver failed, it's that the expectations were wrong from the beginning. Silver is not a guaranteed ticket. It's a volatile asset. It can be brutal. It can rip higher and then spend years going nowhere. It can double and then cut in half. That's why the mindset matters as much as the metal itself. And here's another truth that people miss. FOMO isn't only buying at the top. FOMO can go the other direction too. I saw a perfect example of this at a coin show not long ago. A dealer was selling a pile of silver, 10-ounce bars, premium coins, a mix of pieces that clearly took time to build up. And the way he was pricing it, it was obvious he wanted it gone. He wasn't holding out for maximum profit. He was trying to move it. Why? Because he had the opposite kind of FOMO. He wasn't afraid of missing the upside. He was afraid of reliving the downside. He remembered 2011. He remembered the crash. He remembered how long silver stayed depressed. And he didn't want to be the person holding a bag if history repeated. So he set an expectation in his mind about what silver was going to do next, and he acted on that expectation without actually knowing. That's the part that connects both sides of the market. The person who buys at $100 because they're sure it's going to $200 is acting on an expectation. The person who sells aggressively at $60 because they're sure it's going back to $20 is also acting on an expectation. Both are trying to know what the market is going to do. And more often than not, one or both of them will be wrong, sometimes painfully wrong. That dealer could have waited a relatively short time and sold that same metal for more if the move went the other way. But he sold because he had already convinced himself that the elevator was going to drop, and he wanted out before it did. That's not a strategy, that's a prediction with emotion attached. This is why I keep coming back to the same argument. Silver, for most people, only really makes sense as a long-term hold. If you're buying silver for the reasons I'm buying it, you're not buying it because you think it's going to make you rich next month. You're not buying it because you want to flip it for a quick profit. There are other vehicles for that. Stocks, bonds, businesses, real estate, whatever fits your personality and risk tolerance. The role silver plays, at least for me, is closer to this. It's a way to move a portion of savings out of the banking system and into something tangible. It's a way to hold value in a form that can't be printed overnight. It's a way to opt out, at least partially, of a system that relies on constant expansion of debt and money supply. Now, I'm not going to pretend there's no risk. There is risk. If you treat silver as savings and then you're forced to sell at a terrible time, yes, you can get hurt. That's why I always tell people, before you even think about stacking metals, you should have a separate cash emergency reserve, real cash, for real emergencies. Because if your furnace dies, or your car breaks down, or you have a medical bill, you don't want to be forced to liquidate silver during a smash lower just to survive. But after you've covered that basic safety net, you can make a case, especially long-term, for owning tangible assets. And the reason is simple. I don't trust the dollar as a long-term store of value. You don't even need a complex theory to see why. Watch the debt number change in real time. Seriously, take a snapshot of the debt figure, walk away for a few hours, come back. It's higher, not by a little, higher in a way that should make people question the long-term direction of purchasing power. And if you really want the detail that makes it hit harder, don't just look at the total debt. Look at the interest. There's a number that should be front and center in every conversation about the dollar, inflation, and long term savings: the annual interest cost on the debt. That interest expense has climbed to around the $1 trillion range, roughly on par with, and in some comparisons even higher than, major categories like defense spending, which is often cited around the $900 plus billion level annually. Think about what that implies. We are spending an absurd amount of money not on services, not on infrastructure, not on improving productivity, not on anything that makes the country stronger, just on the interest, just to service the existing debt. And as rates rise, that burden grows. That means the interest cost itself can accelerate the debt growth. At that point, it starts to feel less like a problem that will be solved and more like a machine that feeds itself. And if you ever needed a simple explanation for why people lose confidence in fiat currency over long periods, that's it. The incentives are aligned toward more borrowing, more deficits, more issuance, and eventually more erosion of purchasing power. It might not happen in a straight line, and it might not look dramatic day to day, but it shows up over years. Everything costs more, and savings buy less. So when I say I'm bullish on silver long term, I'm not saying silver is going to behave nicely. It won't. I'm not saying silver is a safe short term investment. It isn't. Silver can drop hard. It probably will drop hard again at some point. I'm not saying the floor is real. It isn't. Floors are stories people tell themselves when price stops falling for a while. What I am saying is this: the people who get hurt the most in silver are not the ones who expect volatility. They're the ones who believe they've eliminated it. They're the ones who decide the market owes them a certain outcome. They're the ones who anchor to a number and build their entire plan around it. They're the ones who start stacking with greed instead of discipline, or panic selling with fear instead of patience. Silver might trade at $70, $80, $100. Who knows? Maybe it does. Maybe it goes much higher. It also might go much lower first. The market doesn't care what feels fair, and it definitely doesn't care what you need it to do to validate your last purchase. That's why the only approach that makes sense, in my opinion, is to build a strategy that can survive both directions. Be ready for it to go up, and don't get reckless. Be ready for it to go down, and don't get shaken out. Don't assume there's a guaranteed floor. Don't assume you've figured it out. Don't build your plan around predicting the next move. If your reason for owning silver is long-term protection, diversification, and opting out of a system you don't trust, then the daily price swings shouldn't control you. They might be uncomfortable, they might be frustrating, but they shouldn't change your identity or your plan. And if your reason for owning silver is to get rich quickly, then at least be honest with yourself that you're speculating, and that speculation cuts both ways. Because the truth is, nobody controls this market. Nobody can perfectly time it, and there is no permanent guaranteed floor for silver. It doesn't exist. But just because silver can drop doesn't mean it isn't worth owning. For me, it's the opposite. The very fact that it's volatile, the fact that it's hated at times, the fact that it gets mocked, the fact that sentiment flips from euphoria to despair, that's part of what makes it a real asset. It's not a stable bank balance. It's not a number on a screen backed by unlimited issuance. It's something you can hold, something finite, something that has function and demand outside of just being a trade. So if you're watching the negativity ramp up and you're wondering what to do, my message is simple. Don't let the crowd drag you into extremes. Don't let the bulls convince you risk is gone, and don't let the bears convince you the long-term thesis is dead. Respect the elevator, respect the history, respect that silver can do the unthinkable, and build a plan that doesn't break when it does. That's what I had for today. If you got value out of this, let me know what you think silver does next. Do you believe the widely watched levels hold, or do you think the elevator drops to a lower floor first? And most importantly, what's your reason for owning silver? A quick flip or a long-term hedge?